Welcome back to the Deep Dive. Today, we're really going behind the scenes, taking a look at UBS's Year Ahead 2025 report.
Oh,
It's a
fantastic.
fascinating report. Really
Yeah.
kind of gives you that sneak peek into what some of the world's top financial minds are thinking about, where the markets are going, what's happening with the economy, and, really where should savvy investors be putting their money in the coming year.
Well, it's a very intriguing time for this kind of report, especially given the recent U.S. election results and, thinking about all the potential ripple effects across global markets.
Exactly, yeah. And we'll be exploring all of that.
Yeah.
Everything from President Trump's potential impact on trade, fiscal policy, to some of the hottest investment trends like AI and power and resources. Those are really big right now.
And we'll also be diving into some of the long-term forces that UBS has identified as really shaping the next decade, those 5 Ds they talk about: debt, deglobalization, demographics, decarbonization, and digitalization.
A lot to unpack.
Yeah.
But let's just jump right in.
Absolutely.
So, starting with, UBS's take on just the economic landscape,
Sure.
what's their overview of 2024 and what do they see on the horizon for 2025?
Well, they start by acknowledging the surprising resilience of the global economy in 2024.
Yeah.
Despite facing those headwinds, geopolitical tensions, persistent inflation, we still saw really strong economic growth, particularly in the US, and equity markets have been on a tear.
Yeah, it's been amazing.
Global equity's up, about 50% since 2020?
That's like the roaring 20s all over again.
Yeah.
Is that what UBS is thinking too?
They seem to think the party might continue, at least for the U.S. economy.
Yeah.
They're projecting continued growth in 2025, albeit at a slightly slower pace, but still driven by consumer spending and, under the new administration, probably looser fiscal policy.
So continued growth, that's good news for investors.
Yes.
But, what about some of those risks that we keep hearing about? Tariffs, the growing deficit. How does UBS factor that into their outlook?
Well, they're anticipating U.S. GDP growth to kind of hover around 2% in 2025, and their analysis really highlights the continued strength of the U.S. consumer, fueled by strong income growth, healthy savings rates.
That makes sense.
So that's a major driver, or really a major driver of their optimistic outlook, even with, some of those potential headwinds on the horizon.
Yeah, a confident consumer, that's the backbone of any strong economy.
Absolutely.
What about inflation? Because it's been a major concern for investors in recent years.
Right.
Does UBS see it cooling down anytime soon?
They're actually predicting that inflation will continue to fall in 2025, even with the possibility of, those tariffs causing some price bumps.
Okay.
They point to the deflation we've seen in U.S. goods prices over the past 3 years and signs that even those stubborn housing costs are starting to ease.
So that could give the Fed some breathing room.
Yes.
When it comes to interest rates, what's UBS's take on where rates are headed?
They believe the Fed will likely continue cutting rates in 2025, aiming for another 100 basis point reduction. And that would bring rates pretty close to what they estimate is their neutral level of about 3.25 to 3.5%.
So this lower rate environment is definitely something investors need to pay attention to
Absolutely.
when they're making their decisions.
Yes.
We'll be exploring the implications for different asset classes later on.
Absolutely.
But shifting our focus beyond the U.S. for a moment, what's the outlook for other major economies? Because UBS highlights some, interesting regional variations there.
Yes, they do.
So let's start with Asia. What's the story there?
For Asia, they're anticipating slightly slower overall growth in 2025, with a divergence in performance.
Okay.
They see stronger growth in India, Indonesia, which are really benefiting from favorable demographics and structural reforms.
Right.
While China's growth is expected to weaken due to the impact of tariffs and, a slowing property market.
Yeah, aligns with what we're seeing in the headlines.
Yeah.
What about Europe? Any reason for optimism across the pond?
Well, UBS paints a mixed picture for Europe.
Okay.
They anticipate uneven and subdued growth overall, but with potential for some improvement compared to 2024. Tight fiscal budgets and a pressured manufacturing sector are acting as headwinds.
Yeah, definitely.
But higher defense spending, in response to the ongoing war in Ukraine, and nearshoring trends could actually provide a little bit of a boost.
Interesting. So a bit of a wait-and-see approach for Europe.
Yes.
Now, let's turn our attention to the kind of the elephant in the room, President Trump's second term and its potential impact on the markets.
Yeah.
Investors are definitely wondering how his policies will shake things up.
Right.
So UBS delves into this question, analyzing how a second Trump term particularly with a Republican-controlled Congress,
Mhm.
could influence, global economics and geopolitics.
Yes.
So let's start with trade, which has been a major focus of President Trump's agenda. What are the key takeaways from UBS's analysis on trade?
Well, they highlight the likelihood of President Trump continuing his approach of bilateral and selective tariffs rather than imposing, those blanket tariffs on China.
Okay.
So this means we could see targeted actions aimed at specific industries or countries, that kind of thing.
So a more strategic approach,
Yeah.
but still likely to create some uncertainty
Oh, absolutely.
and volatility
Yes.
for businesses and investors.
Yeah.
What about fiscal policy?
Yeah.
President Trump campaigned on, further tax cuts, deregulation.
Right.
How does UBS see those promises playing out in his second term?
They acknowledge that while these measures could stimulate the economy in the short term,
Sure.
there's likely to be pushback from Congress, particularly from, those fiscal hawks concerned about the already substantial budget deficit.
It's a classic political tug of war.
Oh, yeah.
The president pushing for his agenda
Right.
while Congress tries to rein in spending. Now, what about the Fed? How do they see the central bank navigating this new landscape, especially with the potential for tariff-induced inflation?
Well, UBS believes that the Fed will likely stay the course on rate cuts,
Oh.
despite the potential for tariffs to create some inflationary pressure.
Right.
Their analysis suggests that the Fed will prioritize achieving a neutral policy stance and might kind of look past any, temporary price hikes caused by tariffs.
So a balancing act for the Fed as they try to support
Exactly.
economic growth while keeping inflation in check.
Exactly.
And finally, let's touch on the geopolitical implications of President Trump's peace through strength approach. How does UBS factor this into their analysis?
Well, they acknowledge that this approach, which often involves, taking a more assertive stance on the global stage,
Yeah.
could inject some volatility into markets, especially, as investors are seeking greater stability.
Right.
They anticipate kind of a continuation of President Trump's confrontational approach towards China, potentially some strains in transatlantic relations,
Yeah.
and a maximum pressure strategy on Iran.
Buckle up, investors. It sounds like we're in for a potentially bumpy ride on the geopolitical front.
They could be.
But let's shift gears now and talk about what all this means for your investment portfolio.
Sure.
With interest rates expected to fall further, making cash less attractive,
Right.
where should you be putting your money in 2025?
Well, UBS advises investors to position for lower rates, and they specifically recommend considering high-grade and investment-grade bonds as a core holding.
So with so many different types of bonds out there, why are those the ones that UBS is recommending right now? What makes them stand out in this environment?
Well, they point out that high-grade and investment-grade bonds are currently attractive because yields are higher than they've been in recent years.
Okay.
Technical factors are also supportive, and there's potential for, some solid mid-single-digit returns.
Okay.
Plus, they can provide a measure of risk management in case the economy, takes an unexpected downturn.
It's all about balancing risk and reward,
Absolutely.
especially in today's uncertain market.
Yes.
So not putting all your eggs in one basket, but diversifying into these types of bonds.
Exactly.
Are there any other fixed income strategies UBS is suggesting?
They suggest that while investment-grade bonds offer a good balance of risk and reward, including some riskier credit in a portfolio, can potentially enhance returns and provide greater diversification.
Okay.
They mention U.S., EUR, and Asia high-yield emerging market bonds, senior loans as potential options.
So for investors who are comfortable taking on a bit more risk,
Yeah.
those areas might be worth exploring.
Yeah, potentially.
Now let's talk about equity income strategies.
Yeah.
How can investors generate income in this environment, especially with interest rates so low?
Well, UBS highlights the appeal of high dividend, dividend growth, and option premia strategies, especially since they could potentially offer yields that exceed cash by the end of the year.
Okay.
They even suggest put writing and covered call writing as strategies to potentially boost income even further.
So for income-focused investors,
Yeah,
these strategies can be a valuable tool
absolutely.
for generating cash flow from their portfolios.
Yes.
Now, let's shift our attention to a topic that's been generating a lot of buzz lately.
Yeah.
Artificial intelligence.
Right.
UBS is calling AI the investment opportunity of the decade. What's driving their bullish outlook on AI?
Well, we're already seeing a surge in AI-related capital expenditures, with major tech companies like Alphabet, Amazon, Meta, and Microsoft.
They're all in.
They're pouring billions into this space. They're projected to spend a combined $222 billion on AI in 2024 alone, and that's a 50% increase from 2023.
Those are some staggering numbers.
Yes.
Clearly, these tech giants are betting big on AI.
Absolutely.
What does this mean for everyday investors who are looking to capitalize on this trend?
Well, UBS has some clear recommendations. First and foremost, they stress the importance of ensuring sufficient investment in AI. They argue that the rapid pace of growth in this industry means that being underallocated to AI has actually become even riskier.
So don't get left behind in the AI revolution.
Right.
What specific areas of AI are they recommending? Where should investors be focusing their attention?
For now, they suggest tilting towards what they call the enabling layer of the AI value chain.
Okay.
This includes companies involved in semiconductors, which are, the building blocks of AI systems,
Right.
and cloud services, which provide the infrastructure for AI applications.
So why focus on this segment of the AI ecosystem? What makes it so compelling for investors?
They believe this segment offers a sweet spot in terms of risk and reward. It has strong growth potential, favorable competitive positioning, and valuations that haven't gotten too far ahead of themselves.
Right.
It's really where the early action is, and investors can potentially benefit from the rapid expansion of this foundational layer.
It's like investing in the picks and shovels during a gold rush.
Right, exactly.
But what about the longer-term opportunities in AI? Where do they see the biggest potential down the road?
Well, UBS emphasizes the importance of diversifying investments between those listed mega caps, those established tech giants leading the charge,
Sure.
and innovative private companies that are developing cutting-edge AI applications.
So a balanced approach
Yeah,
that combines the stability of those big players with the potential for higher growth from those up-and-coming innovators.
right.
But they also caution that, private market investing comes with its own set of risks, right?
Oh, it's absolutely.
Especially for investors who aren't familiar with that space.
Exactly. It's important to understand the unique risks and challenges of private market investing before diving in.
Great points.
Yeah.
Now, shifting gears again, UBS is also highlighting another major trend that they believe will create significant investment opportunities,
Okay.
and that's power and resources. What's driving this opportunity, and why are they so bullish on this sector?
They're seeing a convergence of factors that are driving up electricity demand around the world. And the rise of AI data centers, which require massive amounts of energy to operate, is a key driver.
Oh, yeah, of course.
Also, industrial electrification, as more manufacturers shift away from fossil fuels, that's another major factor.
And of course, electric vehicles,
Yes,
putting a strain on the grid as well.
absolutely.
But UBS sees this increased demand as a positive thing, right?
Oh, yeah.
Creating opportunities.
Across the entire power and resources value chain.
Absolutely, yeah. So what specific segments within this value chain are they finding most attractive for investors?
They believe the transmission and distribution segment will likely see the strongest growth, Years of underinvestment have left grids in developed markets in desperate need of upgrades, while emerging markets need extensive build-outs to meet that rising demand.
That sounds like a massive undertaking,
It is.
with huge potential for companies involved in upgrading and expanding the grid. What about those raw materials we were just talking about, like copper and aluminum?
Mhm.
Are they a part of this investment opportunity too?
Absolutely. Electrification and renewable energy are driving a surge in demand for metals like copper, which is used in everything from wiring to electric motors, and aluminum, which is essential for, lightweighting in vehicles and renewable energy infrastructure.
It's not just about building the infrastructure. It's also about sourcing the materials needed to make it happen. What about the companies involved in generating and storing electricity? Are those attractive areas for investment as well?
While long-term growth is expected in electricity generation technologies, including renewables like solar and wind, natural gas hydrogen, and even nuclear power, there are challenges.
Right, of course.
Developing new capacity is complex, it's time-consuming, and can be impacted by factors like regulatory hurdles and supply chain disruptions.
So a lot of moving parts in the energy sector.
Yes.
But what's UBS's advice for investors who are looking to capitalize on this, long-term trend towards electrification? How can they navigate those complexities and find the most promising opportunities?
They suggest prioritizing companies with strong financial health and competitive advantages in specific technologies, such as solar, wind, nuclear, and natural gas hydrogen. They also see immediate growth opportunities in emerging technologies like advanced battery storage, which is crucial for managing, the intermittency of renewable energy sources,
Of course.
and small modular nuclear reactors, which offer a more flexible and scalable approach to nuclear power generation.
So it's about finding those companies that are well positioned to benefit from that transition to a cleaner energy future.
Absolutely.
Now let's move on to another crucial aspect of investing: navigating the ever-changing currency markets.
Right.
UBS has some interesting predictions about the US dollar, the euro, and other major currencies. What's their outlook and what should investors be watching for?
Well, the US dollar is entering a period of uncertainty. While factors like tax cuts and deregulation could attract capital inflows and support the dollar in the short term, other forces are at play. Immigration controls could tighten the labor market and keep interest rates higher, while tariffs could impact trade flows and, currency valuations.
It sounds like a very complex web of factors
It is.
influencing the dollar's trajectory.
Absolutely.
So what's UBS's overall prediction for the direction of the dollar? Will it continue to reign supreme, or are we headed for a shift in the global currency landscape?
Despite those potential short-term boosts, UBS believes the dollar is currently overvalued and overstretched.
Okay.
They anticipate a gradual weakening against the euro, projecting the USD rate to reach 1.1 by end of 2025.
So a potential decline for the dollar over the long term, but maybe some short-term fluctuations along the way. What advice do they have for investors who are concerned about their exposure to the dollar? How can they manage that risk?
UBS advises using periods of dollar strength, like we might see in the near term, to reduce exposure through hedging strategies.
Yep.
Switching, USD cash and fixed income holdings to other currencies or using option strategies can help mitigate potential losses.
A strategic approach to currency management is crucial for investors who want to protect their portfolios.
Yeah.
Now let's talk about some other major currencies, because they have some interesting observations about the euro, the Swiss franc, the British pound, the Australian dollar, the Japanese yen, and the Chinese yuan, each with their own unique dynamics and potential for movement.
They do.
So let's start with the euro. They're predicting it will strengthen against the dollar. What's their reasoning behind that? Is it just about the dollar weakening, or are there other factors at play?
Well, UBS acknowledges that while Eurozone growth might not be robust, it's expected to improve slightly. They also point out that sentiment towards the euro is currently quite muted.
Okay.
So there's potential for some positive surprises, which could, boost the currency.
So maybe an undervalued opportunity there,
Potential.
especially if growth picks up, or there are, positive developments on the political or economic front. What about the Swiss franc? How do they see it performing in the coming year?
UBS expects the Swiss franc to be supported by relatively higher interest rates compared to other developed economies, and its safe haven status could also attract inflows if geopolitical tensions escalate.
Yeah, makes sense,
No.
especially given Switzerland's long-standing reputation
Yeah,
as a safe haven during times of global turmoil.
right.
What about the British pound and the Australian dollar? How do they factor into UBS's currency outlook?
UBS sees those as attractive carry currencies.
Carry currencies.
Yes.
Okay, can you explain carry currencies in simpler terms for our listeners who might not be familiar with that term?
So imagine borrowing money in a country with low interest rates like Japan, and then investing that money in a country with higher interest rates like Australia.
Okay.
That difference in interest rates is what's known as the carry. You're essentially earning a profit from the difference in interest rates. But of course, there are risks involved, such as currency fluctuation.
Right, so it's a strategy that can potentially boost returns,
Yes,
but it's not without its risks.
exactly.
Now, let's move on to the Japanese yen. UBS is predicting it will strengthen in the coming year. What's driving that prediction?
They cite several factors supporting the yen. First, they believe it's currently undervalued, especially relative to, current yield differences with the US dollar. They also anticipate that the yield gap between the US and Japan will narrow as the Fed cuts rates and the Bank of Japan potentially raises rates
Okay.
to combat deflationary pressures.
So a potential convergence of factors
Yeah.
that could favor the yen.
Yeah.
What about the Chinese yuan? How do they see it faring amidst, the ongoing trade tensions with the U.S.?
UBS anticipates continued weakness in the Chinese yuan due to the lingering impact of trade tariffs. They believe that even though the People's Bank of China is trying to stabilize the currency, the trade war is likely to keep downward pressure on the yuan.
So trade continues to be a major factor influencing the yuan's trajectory.
Absolutely.
Now, let's switch gears and talk about an asset class that's been shining brightly lately: Gold.
Yes.
It's seen some impressive gains recently, reaching new record highs. What's behind this rally? And does UBS believe it has further to run?
Gold's stellar performance in 2024 was driven by a combination of factors. It reached new all-time highs, topping $2,790 per ounce, as investors sought a safe haven amidst, geopolitical uncertainty, persistent inflation, and concerns about the global economy.
But it's experienced a slight pullback since President Trump's election victory. Do they see this as a sign of things to come, or do they believe gold's bull market is still intact?
UBS remains bullish on gold even with that recent dip.
Okay.
They believe gold will continue to shine in 2025, driven by several factors.
Okay.
They point to the ongoing de-dollarization trend among central banks and private asset managers as they diversify their reserves away from the U.S. dollar. Continued central bank buying of gold is another supportive factor,
Right.
as is the expectation of lower real interest rates.
So even though inflation is expected to cool down, real interest rates, which factor in inflation,
Yes.
are likely to remain low, which is positive for gold.
That's right.
And what about the dollar? Didn't we just talk about how UBS is predicting a weakening dollar?
Exactly. A fading dollar is generally positive for gold as it makes the precious metal more attractive to buyers holding other currencies. And then there are those persistent geopolitical uncertainties we discussed earlier.
Yeah.
Those are also likely to keep gold in demand as a safe haven asset.
So it sounds like gold is still viewed as a valuable portfolio diversifier
Absolutely.
and a hedge against various risks.
Yes.
What's their specific prediction for gold prices in 2025? Do they see it continuing its upward trajectory?
They're actually calling for gold prices to potentially rise to new highs in 2025, even exceeding $2,900 per ounce.
That would be quite a rally.
Wow.
Are there any other precious or industrial metals that are catching their attention? Any other potential opportunities in that space?
They briefly touch upon the potential in industrial metals like copper, manganese, rare earths, and lithium, which are all essential for, various industrial applications and ongoing energy transition.
Right.
UBS believes that tightening fundamentals and the continued shift towards cleaner energy will likely support higher prices for these metals in the coming years.
So another area where investors might want to do some digging.
Yes.
Now, let's move on to real estate.
Okay.
It's an asset class that's been through its ups and downs in recent years.
Yes.
How does UBS see the global real estate market shaping up in 2025?
They're actually quite optimistic about global real estate. They're predicting a rebound driven by a confluence of factors. Lower capital costs, thanks to falling interest rates, are making it more affordable to finance real estate investments. Increased debt availability as lenders become more willing to lend is also providing a tailwind. And then there's the surge in private capital seeking deployment. Investors are flush with cash and looking for attractive investment opportunities, and real estate is high on their list.
So a potentially favorable environment for real estate investors.
It could be.
But what about those concerns we've been hearing about oversupply in certain markets and the impact of rising interest rates? How does UBS address those issues?
They acknowledge those concerns, but they also highlight some positive trends. They point to improving supply and demand dynamics, with constrained new supply in many markets meeting robust demand.
Okay.
That's leading to decreasing vacancy rates, which is good news for landlords,
Right.
and rising rental growth, which can boost returns for investors.
So a potential sweet spot for real estate with favorable demand-supply dynamics
Yeah.
and lower borrowing costs.
Yes.
But with so many different types of real estate out there, from office buildings to shopping malls to residential properties, where are they seeing the most attractive opportunities?
They see opportunities across both public and private real estate markets, but they specifically highlight several sectors. In commercial real estate, they're particularly bullish on logistics properties, which are benefiting from, the continued growth of e-commerce. They also like data centers, which are essential for the digital economy, and telecommunication towers, which are crucial for mobile networks.
Those sectors all seem to be riding some powerful long-term trends.
They are.
And what about residential real estate? Where are they seeing the most potential there?
They recommend broad exposure to multifamily, senior, and student housing, but they are more cautious about the UK and China residential markets. They see those markets as potentially oversupplied and vulnerable to economic headwinds.
So a focus on diversification within residential real estate,
Yes.
but with some regional consideration.
Right.
What about retail real estate? It's been struggling in recent years with the rise of e-commerce. Do they see any potential for a turnaround in that sector?
They see select opportunities in retail, particularly in what they call need-based properties that cater to essential goods and services.
Okay.
These properties are less vulnerable to online competition and tend to be more resilient during economic
Yeah.
downturns.
So focusing on the more resilient segments of retail that aren't as exposed to the whims of consumer spending or the threat of e-commerce.
Exactly.
And finally, what's their outlook on the often beleaguered office market? With so many people working from home, is there any hope for office buildings?
They advise caution in the office market, recommending a focus on prime, high-quality central office spaces.
Okay.
They believe that these properties will outperform lower-tier, older properties as companies seek to attract workers back to the office with more appealing and modern spaces.
So flight to quality in the office sector as companies try to
Yeah.
create work environments that will entice employees to return to the office after years of remote work. It's all about adapting to the changing dynamics of the workplace. Now let's zoom out and take a broader look at the forces shaping the world and the investment landscape. UBS has identified 5 major trends, what they call the 5 Ds, that they believe will have a profound impact on the decade ahead. Can you tell us more about these 5 Ds and how they might affect investors' portfolios?
The 5 Ds, debt, deglobalization, demographics, decarbonization, and digitalization, are interconnected trends that UBS believes will be major drivers of both growth and inflation in the coming years.
Okay.
They're like powerful currents, shaping the global economy and creating both challenges and opportunities for investors.
It sounds like a fascinating and complex interplay of forces.
It is.
So let's break down each of these 5 Ds one by one, starting with debt. It's been a growing concern for governments and economies worldwide. How does UBS see this playing out over the next decade, and what does it mean for investors?
They highlight the significant growth in government debt that we've seen in recent years, fueled by factors like pandemic-related stimulus spending, aging populations, and increased defense spending in response to geopolitical tensions. And with debt levels at such, elevated levels, governments have less flexibility to respond to future economic shocks, which could lead to greater volatility in bond markets. And that's something investors need to be mindful of when considering, their fixed income allocations.
So potential for heightened risk in the bond market as governments grapple with those debt burdens.
Absolutely.
What about deglobalization? How does UBS see that trend impacting the global economy and investment landscape?
Well, UBS acknowledges the shift towards deglobalization that's been underway for several years, driven by factors like the pandemic, rising nationalism, geopolitical tensions, and even technological changes that are enabling more regionalized production. And they suggest that President Trump's America First policies could further accelerate this trend.
A move away from globalization could have significant implications for businesses and investors alike.
Absolutely.
What are some of the potential consequences of this trend?
They point out that deglobalization could lead to higher costs for both consumers and businesses as supply chains become more regionalized and companies face higher tariffs or other trade barriers. This could potentially dampen global economic growth.
So a potential trade-off between resilience and efficiency.
Right.
On the one hand, more localized production could make supply chains more resilient to disruptions,
Right.
but on the other hand, it could lead to higher costs
Yeah.
and potentially slower growth. How should investors navigate this kind of evolving landscape?
While deglobalization presents challenges, it also creates opportunities in specific sectors.
Okay.
UBS sees potential in companies involved in cybersecurity as nations prioritize protecting their critical infrastructure and data. They also highlight opportunities in reshoring as companies bring manufacturing back to their home countries, and automation as businesses seek to reduce their reliance on global labor markets.
It's all about identifying those companies that are well-positioned to benefit from the changing dynamics of global trade and production.
Right.
Now, let's move on to demographics. How do they see demographic shifts impacting the world over the next decade?
UBS highlights the stark contrast between aging populations in developed countries like the US, Europe, and Japan, and the younger, faster-growing populations in regions like Africa and South Asia.
Okay.
They believe this demographic divergence will have significant economic and social implications.
What are some of the potential investment implications of this, demographic divide?
They see both challenges and opportunities arising from these demographic shifts. Aging populations can lead to slower economic growth and strained social safety nets, but they also create opportunities in sectors like healthcare, senior living, and financial services that cater to the needs of older populations.
It's about understanding the specific needs and demands of different demographic groups and identifying the companies and industries that are best positioned to meet those needs. Now let's talk about decarbonization, which has become a major focus for governments and businesses worldwide. How does UBS see decarbonization shaping the decade ahead?
They anticipate continued regulatory pressure and social activism to push for decarbonization.
Of course.
They expect various factors such as, carbon taxes, environmental regulations, and consumer demand for sustainable products to drive up the cost of carbon-intensive activities and really incentivize investment in cleaner technologies.
So a potential for both costs and opportunities
Yeah.
associated with that transition to a lower carbon economy.
Yeah.
How can investors make sense of this complex landscape and identify the most promising opportunities?
UBS believes that decarbonization will create significant investment opportunities in areas like renewable energy, energy efficiency, carbon capture and storage, and sustainable transportation. They see potential in companies that are developing and deploying these technologies, as well as those that are adapting their business models to align with a lower carbon future.
Decarbonization is not just an environmental imperative. It's also a significant economic transformation
Absolutely.
that will create winners and losers across industries.
Yes.
Finally, let's delve into digitalization, which has been transforming our world at an unprecedented pace.
Yes.
How does UBS see digitalization evolving over the decade, and what's the role of artificial intelligence in this evolution?
They believe digitalization will continue to accelerate, permeating every aspect of our lives and reshaping industries. They see artificial intelligence as a key driver of this transformation, with the potential to automate tasks, enhance productivity, and enable new business models across various sectors.
So AI is not just a futuristic concept, it's already having a tangible impact on the world.
It is.
What are some of the potential investment implications of this digital revolution? How can investors capitalize on this trend?
UBS reiterates their belief that AI will be a major driver of investment returns, with opportunities across, the entire AI value chain, from the companies that are developing the underlying technologies to those that are applying AI to solve real-world problems. They suggest that the AI revolution could actually contribute to both lower inflation and higher economic growth over the long term, potentially leading to higher real interest rates.
A lot to unpack there, and certainly an area where investors will need to stay informed and adaptable. Now, having explored these 5Ds and their potential impact on the global economy and investment landscape, let's shift our focus to UBS's specific asset class expectations. They have provided a detailed outlook for various asset classes, from stocks and bonds to commodities and currencies. What are the key takeaways for investors as they consider how to allocate their capital in the coming year?
Well, UBS begins by reviewing the performance of various asset classes over the past 5 years. A period marked by, significant market volatility and shifting economic conditions. They note that government bonds have struggled amidst rising interest rates, while cash returns have failed to keep pace with inflation. On the other hand, equities have generally performed well, and private markets and commodities have delivered strong returns.
So a mixed bag of performance
It has been. Yeah.
across different asset classes,
Yeah.
reflecting the uncertain times we've been living through.
Right.
But past performance is not necessarily indicative of future results.
Of course not.
What's their outlook for these asset classes going forward? Where do they see the most potential, and where are the risks most pronounced?
Starting with cash, they anticipate it will continue to be among the worst performing asset classes. They point to the ongoing rate cutting cycle, which will further erode cash returns. They also believe that secular trends like deglobalization, decarbonization, high debt levels, and aging populations could exert upward pressure on inflation, further diminishing the real returns on cash.
So a tough environment for cash holders.
It is.
What's their advice for investors who might be sitting on a lot of cash right now? Should they just ride out the storm, or are there more proactive steps they can take?
They recommend shifting excess cash deposits and money market funds into assets that provide higher and more durable sources of income. This could include high-quality fixed income, dividend-paying stocks, or even alternative investments that offer attractive yields.
Makes sense.
Yes.
It's all about putting that cash to work in assets that can potentially outpace inflation and generate better returns.
Exactly.
What about government bonds? They haven't had a great run lately. Do they see any signs of a turnaround for this asset class?
UBS acknowledges that government bonds have experienced one of their worst 5-year periods in recent history. The Bloomberg U.S. Aggregate Government Bond Index, a widely followed benchmark for U.S. government bonds, has actually delivered a negative nominal return over that period.
So not a great track record.
Right.
But are there any reasons for optimism? Any potential catalysts that could drive a rebound in the bond market?
They point out that conditions for government bonds have improved recently, with yields now higher, lower inflation on the horizon, and, central banks expected to continue cutting interest rates. These factors could make bonds more attractive to investors seeking income and stability.
So maybe some light at the end of the tunnel for bond investors.
Potentially.
But they also caution that there are still risks in the bond market.
Of course.
What are some of the potential headwinds that investors should be aware of?
Well, they warn that investors might demand higher risk premiums for government bonds due to concerns about, growing debt levels and the potential for future inflation. They also suggest that bond markets could experience, bouts of volatility, even with central banks intervening to stabilize markets.
It's a reminder that even though bonds are often seen as a safe haven asset class,
Right.
they're not without their risks.
Absolutely not.
What's their advice for investors who are concerned about the potential for losses in the bond market? How can they mitigate that risk?
They recommend diversifying fixed income holdings beyond core government bonds. This could include adding exposure to investment-grade corporate bonds, high-yield bonds, emerging market bonds, or even alternative fixed income strategies like hedge funds or private credit funds.
Diversification is key.
It is.
It's about spreading your risk
Yes.
across different types of bonds in different regions of the world.
Yeah.
Now, let's talk about equities, which have been the star performers in recent years. What's their outlook for this asset class? Do they see the bull market continuing, or are they predicting a correction?
UBS remains positive on the long-term outlook for equities, even though, U.S. equity valuations are currently higher than historical averages. They believe that the ongoing commercialization of artificial intelligence will continue to benefit top U.S. tech companies, driving innovation and profitability. They also anticipate that AI will eventually boost productivity and profit margins across a wider range of sectors and markets, both in the U.S. and globally.
So they're betting on AI to be a transformative force
Yes.
that will drive continued growth in the equity markets,
Right.
but they also acknowledge that valuations are elevated,
Right.
which could make stocks vulnerable to a pullback
Yeah.
if there's a shift in investor sentiment or a change in the economic outlook.
Exactly. And they highlight the potential for equities to outperform fixed income in an inflationary environment, as companies can often pass on higher costs to consumers through higher prices.
So equities as a potential hedge against inflation, but also an asset class that can be volatile in the short term. What's their specific advice for equity investors? How should they be approaching this asset class in the coming year?
They advise investors to maintain adequate exposure to developments in AI, either through, direct investments in AI-focused companies or through, broader technology sector funds. They also stress the importance of global diversification within equity portfolios, ensuring exposure to both developed and emerging markets to capitalize on growth opportunities around the world.
Makes sense. It's about balancing the potential for growth with the need to manage risk.
Absolutely.
Now let's move on to alternative investments, which have become increasingly popular among, sophisticated investors in recent years.
Yes.
How does UBS view this asset class? Are they recommending alternatives for everyone, or are there certain types of investors who might benefit most from this asset class?
They highlight the strong performance of private equity so far this decade, with annualized returns consistently outpacing those of global public equities. They attribute this outperformance to factors such as, the ability of private equity managers to identify and invest in undervalued companies, operational improvements they can implement within portfolio companies, and, the illiquidity premium that investors demand for locking up their capital for longer periods.
So a combination of factors
It is.
that have contributed to private equity's strong track record.
Yes.
But they also acknowledge that private markets come with their own set of risks and consideration.
Right, exactly. Private equity investments are illiquid, meaning they can't be easily bought or sold on public exchanges. This makes them unsuitable for investors who might need to access their capital quickly.
So a longer-term investment horizon and a higher tolerance for illiquidity are essential
Absolutely.
for investors considering private equity.
Yes.
What about other types of alternative investments? Are there any other areas of this asset class that they find compelling?
They also point to the expansion of private credit funds in recent years. These funds have stepped in to fill the void left by banks that have retreated from certain lending activities, offering loans to companies that might not qualify for traditional bank financing. And they're seeing attractive returns in this space as demand for private credit continues to grow.
So another potential source of diversification and yield within the alternative investment universe.
Right.
What's their specific advice for investors who are considering allocating to alternatives?
Yeah.
How much of a portfolio should they be allocating to this asset class, and what are the key considerations?
They believe that investors can consider replacing up to 30% of their public equity exposure with private market investments, depending on, their individual circumstances and tolerance for illiquidity. They particularly like private credit, value-oriented buyouts, secondaries, which involve buying existing private equity investments from other investors, and thematic investments in areas like, software, healthcare, and climate change solutions.
That's a significant potential allocation to alternatives.
It
It's clear that UBS sees this asset class as playing an important role in a well-diversified portfolio. Are there any other alternative investments they highlight? What about hedge funds? Do they see a place for those in a portfolio?
They also discuss hedge funds, which are investment funds that use a variety of strategies to generate returns, often employing leverage and short selling.
Right.
They believe that certain types of hedge funds, such as, global discretionary macro hedge funds, can act as diversifiers or substitutes for other assets within a portfolio. They suggest that investors consider allocating around 10% to hedge funds with a focus on strategies that have a low correlation to traditional stocks and bonds.
So hedge funds as a potential tool for enhancing diversification
Yes.
and reducing portfolio volatility.
Yeah.
But hedge funds have a reputation for being, complex and risky.
Yeah.
Are they suitable for all investors, or are there certain types of investors who should steer clear?
Hedge funds are definitely not for everyone. They're typically only available to accredited investors, which are, individuals or institutions that meet certain income or net worth requirements. And as you mentioned, they can be complex and risky, employing strategies that might not be suitable for all investors.
It's important to understand the risks and potential drawbacks of any investment strategy before diving in.
Absolutely.
Now, let's move on to commodities, which have seen a resurgence in recent years amid concerns about inflation and supply chain disruptions. What's their outlook for this asset class?
UBS acknowledges that commodities have delivered impressive returns over the past 5 years, driven by, rising global demand for energy and industrial metals, as well as their role as an inflation hedge.
But with the global economy slowing down and some experts predicting a recession, how do they see the commodity market evolving in the coming years?
They believe that a range of long-term forces will shape the commodity market, creating both opportunities and challenges for investors. They highlight deglobalization, which could lead to regional scarcities of certain commodities as countries prioritize domestic production and reduce their reliance on global supply chains.
So a potential for increased volatility in commodity markets
Absolutely.
as geopolitical tensions and protectionist policies disrupt trade flows.
Right.
What other factors are they watching?
They also point to the ongoing energy transition as the world shifts away from fossil fuels and towards cleaner sources of energy.
Right.
This transition is creating increased demand for certain metals and minerals that are essential for renewable energy technologies, battery storage, and electric vehicles.
So a potential boom for commodities that are critical to the green energy revolution.
Absolutely.
But aren't there also concerns about oversupply in some of these markets? How does UBS address that issue?
They acknowledge that oversupply can be a concern in commodity markets, especially if demand growth slows or new production comes online faster than expected. But they believe that the long-term trends supporting demand for certain commodities, such as, the energy transition and the growth of developing economies, will ultimately outweigh these short-term fluctuations.
It's a long-term game,
Yes.
and investors need to be patient and selective. What about the impact of artificial intelligence on commodity markets? Didn't we talk earlier about how AI is expected to drive productivity growth and potentially lower inflation? How could those factors affect commodity prices?
That's a great question. AI could have a significant impact on commodity markets, both directly and indirectly. For example, AI is being used to optimize mining operations, which could lead to increased production and potentially lower costs. And as AI drives efficiency gains across industries, it could dampen demand for certain commodities that are used in, manufacturing processes.
A potential for both upward and downward pressure on commodity prices, depending on the specific commodity and how AI is being applied.
Exact.
It's a complex landscape, and investors will need to be diligent in their research and analysis.
Absolutely.
What's UBS's overall recommendation for commodity investors? Should they be overweighting this asset class, underweighting it, or just sticking to a neutral allocation?
Given the potential for, elevated commodity volatility in the years ahead, They suggest a tactical and actively managed approach to long-term commodity exposure.
Okay.
This could involve investing in commodity-focused funds that have, experienced portfolio managers who can navigate the complexities of these markets and identify the most promising opportunities.
So not just buying and holding a basket of commodities, but actively managing that exposure
Exact.
to potentially enhance returns and
Right.
mitigate risk.
Right.
Now let's move on to currencies, which can be a challenging asset class for many investors to understand and navigate.
Yes.
What are the key takeaways from UBS's analysis of currency markets? What are the major trends they're watching, and what's their outlook for the dollar and other major currencies?
They highlight the remarkable outperformance of the U.S. dollar over the past decade, fueled by factors such as, the strength of the U.S. economy, the attractiveness of U.S. assets, and the role of the dollar as the world's reserve currency.
Right.
But they believe that the forces that have supported the dollar's dominance are starting to fade.
Interesting. So they're seeing a potential shift
Yes.
in the global currency landscape.
Yeah.
What are the factors driving this potential shift away from the dollar?
They point to several factors. One is the growing U.S. fiscal and current account deficits, which, reflect the gap between government spending and revenue and between imports and exports.
Right.
These deficits can put downward pressure on a currency as it signals that a country is borrowing more from the rest of the world than it is lending.
So the U.S. is essentially living beyond its means,
Right.
which could erode confidence in the dollar over the long term.
It could.
What other factors are they watching?
They also highlight the rise of other currencies, such as, the euro and the Chinese yuan, which are challenging the dollar's dominance in global trade and finance. As these currencies become more widely used, it could reduce demand for the dollar and potentially lead to a decline in its value.
It's a multipolar world, and the dollar is facing increasing competition from other currencies.
Absolutely.
What's their specific advice for investors who are concerned about currency risks in their portfolios? How can they manage that risk?
They recommend actively managing currency exposure through strategies such as hedging, switching currency holdings, and using options. Hedging involves using financial instruments to offset potential losses from currency fluctuations. Switching currency holdings involves converting assets from one currency to another, potentially reducing exposure to a weakening currency. And using options involves buying contracts that give you the right, but not the obligation, to buy or sell a currency at a specific price in the future, providing a way to limit potential losses.
So a range of tools and strategies
Yes.
that investors can use to manage currency risk.
Absolutely.
Now, having explored UBS's outlook for various asset classes, let's turn our attention to their strategic planning recommendations. They outline a framework called Liquidity, Longevity, Legacy
Right.
to help investors align their goals with appropriate strategies over different timeframes. Can you explain this approach in more detail?
UBS's Liquidity, Longevity, Legacy approach is a holistic framework for financial planning that recognizes that investors have different needs and goals at different stages of their lives.
Okay.
It encourages investors to think about their financial lives in three distinct buckets: liquidity, longevity, and legacy.
That's a great way to visualize it.
Yeah.
It's like having different compartments
Right.
for your money, each with its own purpose and investment strategy.
Exactly.
Can you break down each of these three components and explain how they fit into this framework?
So, liquidity focuses on your short-term needs, covering expenses, liabilities, and spending plans for the next 3 to 5 years. This is the money you need to keep readily available, so it should be invested in assets that are safe, liquid, and unlikely to fluctuate significantly in value.
So your safety net, the money you need to have on hand
Right.
for unexpected expenses or short-term goals. What types of investments are appropriate for the liquidity bucket?
UBS recommends holding these funds primarily in cash and short-term bonds. Cash includes checking accounts, savings accounts, money market accounts, and certificates of deposit, or CDs. Short-term bonds are bonds that mature in 1 to 3 years and are considered, relatively low-risk investments.
So a focus on preserving capital and ensuring easy access to funds when needed. What about the longevity bucket? What's the purpose of that compartment?
Longevity refers to the funds you'll need to meet your financial goals throughout your lifetime, such as funding your retirement, paying for your children's education, or buying a home. This bucket requires a longer-term investment horizon and a greater tolerance for risk.
So you're aiming for growth in this bucket,
Yes.
but you also need to manage risk
Right.
and ensure that your investments are aligned with your time horizon. What types of investments are suitable for the longevity bucket?
UBS suggests investing these funds in a well-diversified global portfolio that includes a mix of stocks, bonds, real estate, and potentially alternative investments. The goal is to balance long-term growth potential with diversification to manage volatility and, reduce the risk of running out of money during your lifetime.
So a balanced approach
Yeah,
that takes into account both growth and risk management.
exactly.
And finally, the legacy bucket. What's the purpose of this bucket and what types of investments are appropriate for it?
Legacy is all about maximizing growth and impact for goals that extend beyond your lifetime, such as leaving a bequest for your heirs, funding a charitable foundation, or, making a positive impact on the world through impact investing.
So this is the bucket for your long-term aspiration, the things you want to achieve with your wealth that go beyond your own personal needs. What types of investments are appropriate for the legacy bucket?
Since your immediate needs are covered by the liquidity and longevity components, the legacy portion can focus on maximizing growth through higher risk investments, such as, growth stocks, emerging market equities, or illiquid alternative investments. Alternatively, it can be directed towards impact investing to align your investments with your values and create positive change in the world.
That's a really powerful concept.
Yeah,
It's about recognizing that your wealth can be used to make a difference even after you're gone.
absolutely.
Now, having explored this liquidity, longevity, legacy framework, let's delve deeper into some of UBS's specific recommendations for implementing this approach. They start with a key piece of advice. Put cash to work. Why are they so adamant about this, especially in a lower interest rate environment?
They highlight the historical underperformance of cash compared to other asset classes, showing how stocks have consistently outperformed cash over, various holding periods. Right. And they emphasize that this imperative to put cash to work will only grow stronger in 2025 as interest rates continue to fall, further eroding cash returns.
So holding on to excess cash is like watching your money slowly lose purchasing power as inflation eats away at its value.
Exactly.
What specific actions do they recommend for putting cash to work? What are some of the options for investors who are looking to deploy their cash into higher returning assets?
They suggest several options depending on, your risk tolerance and investment goals. For investors seeking, more stability in income, they recommend switching cash into high-quality fixed income. This could include investment-grade corporate bonds, municipal bonds, or even U.S. Treasury bonds. These investments offer a predictable stream of income and are generally less volatile than stocks.
So a good option for those who want to preserve capital and generate a steady stream of income. What about investors who are looking for more growth potential? What options do they have for putting their cash to work?
For those seeking more growth potential, they suggest deploying excess cash into equity income or balance strategies. Equity income strategies focus on investing in stocks that pay dividends, providing a source of income and the potential for capital appreciation as the value of the underlying stocks increases.
So a way to participate in the growth of the stock market while also generating some income along the way.
Yeah.
What about balance strategies? How do those work?
Balanced strategies typically invest in a mix of stocks and bonds, aiming to achieve a balance between growth and stability.
Okay.
The specific allocation between stocks and bonds depends on, your risk tolerance and investment goals.
So a more diversified approach
Yeah,
that can potentially smooth out the ups and downs of the market.
exactly.
They also mention annuities as a potential option for generating income.
Yeah.
Can you tell us a bit more about how annuities work and why they might be suitable for certain investors?
Annuities are contracts between an individual and an insurance company, where the individual pays a lump sum or makes regular payments to the insurance company in exchange for a guaranteed stream of income, either for a specific period or for life.
So a way to create a guaranteed stream of income, similar to a pension,
Right.
but annuities can be complex
Yes, they can.
and come with their own set of fees and restrictions.
Yeah,
It's important to understand the details before investing.
absolutely.
Now let's move on to their next piece of advice. Strengthen your core. What do they mean by that?
Well, they recognize that investors often get caught up in the complexity of managing, various individual investments and can lose sight of their overall financial goals, especially when markets become volatile and emotions run high.
Yeah, it's easy to get caught up in the day-to-day and lose sight of the big picture.
Right.
So they emphasize the importance of having a solid core portfolio that serves as the foundation of your investment strategy. So it's about creating a strong base for your portfolio, something you can rely on to weather the storms and keep you on track to achieve your long-term goals. What are the essential elements of a core portfolio?
A core portfolio should be well diversified. meaning it should include a mix of different asset classes, geographies, and sectors. It should be aligned with your long-term investment goals and risk tolerance, and it should be designed to deliver consistent returns over time.
So not chasing the latest hot stock or
Right.
trendy investment,
No.
but building a portfolio that's designed for the long haul.
Exactly.
What are the benefits of establishing this core component within a portfolio?
They believe that by establishing a strong core and letting it deliver compounded returns over time, investors can gain confidence that their financial goals are being addressed while freeing up time and mental energy to pursue other passions or to explore, tactical satellite opportunities.
Makes sense. It's
Yeah.
like having a solid foundation for your house.
Ah.
You need that strong base to support everything else.
Right.
Now, their next piece of advice is diversify with alternatives.
Right.
Why are they so keen on including alternative investments within a portfolio? What are the potential benefits?
They believe that incorporating alternative investments, such as private equity, private debt, private infrastructure, and private real estate, can enhance diversification and potentially boost portfolio growth. Alternative investments often have different risk and return characteristics than traditional stocks and bonds, so they can help to smooth out portfolio returns and reduce volatility.
Diversification is all about not putting all your eggs in one basket.
Exactly.
By spreading your investments across different asset classes, you can potentially reduce the impact of any single investment on your overall portfolio.
Right.
But alternative investments often come with higher fees and less liquidity than traditional investments, right?
That's true. Alternative investments typically have higher fees than traditional investments, reflecting the specialized expertise and management required to invest in these markets. And as we discussed earlier, they can be illiquid, meaning they can't be easily bought or sold.
So they're not suitable for all investors.
No.
It's important to understand the risks and potential drawbacks before investing in alternatives. What's their specific recommendation for allocating to alternatives? How much of a portfolio should they be allocating to this asset class?
They suggest that investors consider replacing up to 30% of their public equity exposure with private market investments. This allocation should be tailored to your individual circumstances, risk tolerance, and liquidity needs.
That's a significant allocation shift.
It is.
It's clear that UBS sees alternative investments as playing an increasingly important role in portfolio construction. Now, their next piece of advice is optimize your leverage.
Okay.
That might sound a bit intimidating to some investors.
Yeah.
What exactly are they recommending?
It's definitely a strategy that requires careful consideration and a good understanding of the risks involved. UBS believes that proactive, prudent, and strategic borrowing can actually enhance a financial plan, especially as interest rates fall.
That's an interesting perspective. Most people think of debt as something to avoid, but UBS is suggesting that it can be a useful tool if used wisely.
That's right.
What are the potential benefits of using leverage in a financial plan?
They outline several benefits. First, leverage can help manage liquidity, allowing investors to access funds quickly without having to sell assets. This can be helpful for covering, unexpected expenses, tax bills, or capital calls for private equity investments. Second, leverage can improve diversification by allowing investors to borrow against existing assets to invest in less correlated assets, potentially smoothing out portfolio fluctuations and, broadening return sources.
So leverage can be a tool for enhancing liquidity and diversification.
Yes.
What other potential benefits do they highlight?
They suggest that leverage can also be used for currency management. Borrowing in foreign currencies can help to manage exchange rate risks associated with, future foreign income and can provide additional funds for domestic investments. And finally, they acknowledge that for investors with a higher risk tolerance, borrowing can potentially amplify returns if the returns on the investments exceed the borrowing costs.
It sounds like there are a number of potential benefits to using leverage,
There are.
but they also emphasize that it comes with risks, right?
Absolutely. It's a double-edged sword. While leverage can amplify gains, it can also amplify losses.
Right.
If the value of your investments declines, your losses will be magnified if you've used leverage. They stress the importance of carefully comparing loan rates with expected returns, considering refinancing and interest rate risks, and, being aware of the potential for margin calls if the value of the investments declines.
So a lot to consider before jumping into leverage.
Oh, yeah.
It's not a strategy for everyone,
Absolutely not.
and it requires careful planning and risk management.
Yep.
Now let's move on to their next piece of advice. Be active. In a world where passive investing through index funds and ETFs has become so popular, why are they advocating for an active approach to investing?
Well, They recognize the rise of passive investing and acknowledge its benefits, such as, low costs and broad market exposure.
Right.
But they believe that investors need to strike a balance between passive and active strategies based on their specific needs and goals.
So it's not an either proposition.
No.
There's a
Mhm.
place for both passive and active investing in a portfolio.
Yeah.
When do they suggest being more active in your investment approach?
They suggest that in equities, an active approach can be particularly beneficial for investors seeking exposure to new or less prominent markets, such as small cap stocks, emerging growth themes, or emerging markets. They also point out that active management can be helpful for navigating, fast evolving industries or for investing in companies that are not well covered by passive funds.
So an active manager can potentially add value by identifying undervalued opportunities, uncovering hidden gems, or avoiding potential pitfalls that a passive index fund might not be able to do.
Right.
What about fixed income? Do they see a role for active management in the bond market?
Absolutely.
Yeah.
They highlight the complexities of managing bonds with factors like, weights, maturities, cash flows, duration risk, interest rate risk, and credit risk all playing a role.
Right.
They suggest that actively managed bond funds can offer greater convenience and superior risk management compared to, investors trying to manage individual bond exposures themselves.
It's like having a professional bond manager on your team,
Yeah.
navigating the intricacies of the bond market and making adjustments to the portfolio based on changing market conditions and interest rate expectations.
Yeah.
Now, their final piece of advice is go sustainable. What do you mean by that?
They're encouraging investors to consider sustainable investing options across all asset classes. They define sustainable investing as investing in companies and projects that are committed to environmental, social, and governance (ESG) principles, and they emphasize that sustainable investments have shown similar risk and return characteristics as traditional investments.
That's an important point. Some investors might be hesitant to embrace sustainable investing because they're concerned about sacrificing returns. But UBS is saying that you can do well by doing good, so to speak.
Mm.
What are some examples of sustainable investing options that they highlight?
They mention several options. ESG-focused equities invest in companies with strong environmental, social, and governance practices. Green bonds are bonds issued to finance environmentally friendly projects, such as renewable energy projects or energy efficiency initiatives. Sustainable hedge funds incorporate ESG factors into their investment processes, and private market strategies can focus on renewable energy, sustainable agriculture, or other impact-oriented investments.
So a wide range of sustainable investing options to choose from across various asset classes. But didn't they also acknowledge that sustainable investing might face some headwinds in the coming years, given the return of President Trump to the White House and his administration's focus on deregulation and energy independence?
They do acknowledge that there might be some volatility in the short term as policies shift, but they believe that the long-term performance of diversified, sustainable investing strategies will be driven more by investment fundamentals and the macro environment than by political shifts.
That's reassuring for investors who are committed to sustainable investing for the long haul. Now, in addition to these specific investment strategies, they also briefly touch upon philanthropy and blended finance as ways to address social and environmental issues. Can you tell us more about that?
They recognize that some social and environmental issues might not be attractive to investors seeking market rate returns due to factors like size, development stage, location, or business model. They suggest that philanthropic or concessionary funding can play a role in attracting commercial investors to these areas by, reducing risks and encouraging more investment through structures like blended finance.
So blended finance is about combining philanthropic capital with commercial investment to achieve both financial and social or environmental returns. It's like using charitable dollars to leverage larger investments from private investors who might otherwise shy away from these types of projects. What's their take on blended finance? Do they see it as a promising approach to tackling some of the world's most pressing challenges?
They acknowledge that while blended finance holds promise, it's a complex area that requires thorough assessment to ensure that deals are structured in a way that meets both the financial expectations of investors and the social or environmental impact goals of the project.
So a good reminder that due diligence is crucial, even when it comes to impact investing. Now, having covered a lot of ground in terms of investment strategies and opportunities, let's shift our focus to the final sections of the report, where UBS summarizes their asset class forecasts and provides some concluding thoughts. What are the key takeaways from their asset class forecasts?
They provide a detailed table outlining their forecasts for various asset classes, including equities, currencies, interest rates, commodities, and 10-year bond yields, all the way out to 2027. It's a comprehensive outlook that provides investors with, a roadmap for the years ahead.
It's like peering into a crystal ball, trying to get a glimpse of what the future holds for the financial markets. What are some of the highlights of their forecasts? Where do they see the greatest potential for gains, and where are they most cautious?
In equities, they're predicting continued growth for the S&P 500, projecting it to reach 6,600 by the end of 2025, and further gains in subsequent years. They also see upside potential for European and Asian equities, although they acknowledge that tariffs and geopolitical uncertainty could create some volatility.
So overall, a positive outlook for global equities, but with the caveat that there are always risks and uncertainties in the markets. What about their currency forecasts? Where do they see the dollar headed? And what about other major currencies?
They're predicting a gradual weakening of the US dollar against the euro, with the USD exchange rate reaching 1.2 by the end of 2025. They also see potential strengthening for the Japanese yen and continued pressure on the Chinese yuan due to trade tensions and China's economic slowdown.
So a potential for some currency shifts that investors need to be aware of. What about interest rates? Where do they see rates headed in the coming years?
They're projecting continued rate cuts by major central banks, with the U.S. Federal Reserve funds rate falling to 3.33% by the end of 2025. They also see rate cuts in Europe, the UK, and Switzerland. Interestingly, they even predict a potential rate hike in Japan as the Bank of Japan tries to stimulate its economy and combat deflationary pressures.
So a lower rate environment for most of the developed world, but a potential outlier in Japan. How does this interest rate outlook affect their forecast for other asset classes like bonds?
Lower interest rates can be positive for bond prices as investors seek higher yields in a low-rate environment. However, they also caution that bond markets could be volatile if inflation picks up or if central banks change course and start raising rates more aggressively.
So bonds could benefit from this low rate environment, but investors need to be prepared for potential volatility. What about their outlook for commodities? Where do they see prices headed for oil, gold, and other key commodities?
They're predicting moderately higher crude oil prices in 2025, driven by factors like city demand growth and potential supply constraints. They see potential for gold to reach new highs, potentially exceeding $2,900 per ounce as investors continue to seek safe haven assets and inflation hedges. They also highlight the potential for higher prices for industrial metals like copper as demand from electrification and renewable energy projects continues to rise.
So a mixed bag for commodities, with some potential for price appreciation, but also the risk of volatility, as always. Now, having reviewed their asset class forecast, let's move on to their concluding thoughts. What are the key messages they want investors to take away from this report? What are the big picture themes and the actionable advice they're offering?
They emphasize that while the global economy and financial markets are facing a number of challenges and uncertainties, there are also significant opportunities for investors who are well-informed, strategic, and adaptable.
So it's not a time to be complacent or to bury your head in the sand. Investors need to be engaged and proactive. What are some of the specific strategies they recommend for navigating this complex environment?
They reiterate several key themes we've discussed throughout this deep dive. Positioning for lower rates by investing in assets that can benefit from a low interest rate environment, like high-quality bonds or dividend-paying stocks. Capitalizing on opportunities in AI and power and resources by investing in companies that are at the forefront of these transformative trends. And diversifying wisely across asset classes, geographies, and sectors to mitigate risk and enhance potential returns.
Those are all sound strategies that investors can apply to their own portfolios. But they also emphasize the importance of having a well-defined financial plan, right?
Absolutely. They remind us that investing is not just about picking stocks or chasing returns. It's about achieving your financial goals and securing your financial future. A well-crafted financial plan can help you to define your goals, assess your risk tolerance, determine your time horizon, and develop a strategy for achieving your objectives.
So it's not just about the what of investing, it's also about the why. What are you trying to achieve with your investments, and how will your investment strategy help you to get there? Now, before we wrap up, I wanted to ask you a question based on your own analysis of the report. What stood out to you as the most surprising or thought-provoking insight from UBS? What really made you think differently about the investment landscape or about the future of the global economy?
What really struck me was their emphasis on the interconnectedness of these major trends they've identified. the 5Ds. They're not just isolated forces, they're interacting and influencing each other in complex ways. And they're creating a dynamic and unpredictable environment for investors.
It's like a giant puzzle with all these pieces fitting together in ways that we're only beginning to understand. And the picture is constantly changing, so investors need to be adaptable and willing to adjust their strategies as new information emerges.
Exactly. And they highlight the importance of thinking beyond traditional investment models and considering new approaches like blended finance or impact investing to address the challenges and opportunities of this evolving landscape.
It's a reminder that the world is changing, and the investment landscape is changing along with it. Investors who are stuck in the old ways of thinking are likely to fall behind. Now, before we wrap up, they do offer one final piece of advice that I think is particularly important for our listeners to remember.
They remind us that while their report provides a compelling picture of the future, it's just one perspective. They encourage investors to dig deeper, to conduct their own research, to consider their own unique circumstances and goals, and to challenge assumptions.
That's a powerful message. It's about taking ownership of your financial future and not blindly following someone else's roadmap. It's about being an informed and engaged investor who is actively involved in making decisions about your money.
Absolutely. They want investors to be critical thinkers, to question assumptions, and to develop their own perspectives on the markets and the economy. And they emphasize the importance of seeking out diverse viewpoints and not relying on a single source of information.
It's about being an active learner, constantly seeking out new knowledge and perspectives to refine your investment strategy. Well, I think we've covered a lot of ground today, exploring UBS's in-depth analysis of the economic and investment landscape for 2025 and beyond. We've delved into the potential impact of President Trump's second term, examined the transformative trends shaping the decade ahead, and explored a range of investment strategies and opportunities.
It's been a fascinating and thought-provoking discussion, and I hope our listeners have gained valuable insights and actionable advice that they can apply to their own investment journeys.
We've certainly given them a lot to think about. Remember, as UBS emphasizes, this is just one perspective on the future, and it's important to conduct your own research, consider your own financial goals and risk tolerance, and perhaps even consult with a financial advisor before making any major investment decisions.
Sound advice. Investing is a personal journey, and there's no one-size-fits-all approach. The key is to be informed, strategic, and adaptable as we navigate the ever-changing economic and financial landscape.
Well said. Thank you so much for joining us today for this deep dive into UBS's Year Ahead 2025 report. We hope you found it informative and insightful. Until next time, happy investing.